What are the pros and cons of getting hard money loans? All right, everybody, we're going to deep dive into the pros and cons of hard money loans. First off, we should probably say is what is a hard money loan? A lot of people may not be familiar with this. If you're getting into real estate investing, you're going to want to know what this term is. Hard money is lending based upon the asset, not based upon the individual. You see, if you go to Wells Fargo or Bank of the West or Bank of America, or pick your bank or credit union, when they're determining if they should give you a loan or not, what they're taking into consideration is your likelihood of repaying the loan. But the way they're doing that is looking at your credit, your debt to income, your repayment history, and they're looking at how stable your job has been over the last 2 years, which basically means more than likely this guy has done a great job the last few years. His job's going to continue. And he's kept his credit in good shape, so he'll probably continue to do that. And if the debt to income ratio, which is how much you owe in monthly payments against how much you bring in, if that's at a certain ratio and it gives you enough money for housing allowance that is equal or less than the monthly payment, the likelihood that this guy is going to repay is pretty high. In addition to that, like FHA loans and VA loans, and even some of the Fannie and Freddie loans, there's a government subsidy or a government help with banks when they're borrowing against the Federal Reserve. You see, the reason is because the country, the United States, wants to have home ownership, and they've decided that home ownership helps with better citizens in better areas, and so they help subsidize or they make loans available at very low interest rates, which is how the banks actually get the money to loan against in lots of cases, which comes through the Federal Reserves. Now, that all aside, hard money lenders look at it completely oppositely. You see, hard money lenders are lending upon the hard asset, not what's called the soft assets. The soft assets are what we talked about, the ability to repay, how much they've got credit scores. Those things are the soft assets, but the hard assets are what's being lent against. So if it's a house, the house is the hard asset. And so a hard money lender is not looking at the individual primarily, they're looking upon what they're lending on, which in this case is a house. So a hard money lender is going to say, what type of loan to value can I get? And they're typically going to want to be 70% of loan to value. What does that mean? It means that if the property's worth $100,000, the hard money lender, if they're doing a 70% loan to value, is doing a loan for $70,000 or 70% of what the value of the property is actually worth. So that's what hard money lenders are looking for. Now, some of you may say, well, I'm never going to find a property for that. Well, you may not in its current condition, but you can probably fix the property up and get it into that condition. So really good hard money lenders are going to lend on what's called the after repaired value of the property, which means what is this property worth once the repairs are done? And if a lender will lend on the after repaired value of the property. But here or there, you're still dealing with the same situation, which is lending based upon the asset versus lending based upon the propensity to repay based upon the individual. Because in the inverse of that, a bank is going to lend probably 97% of the value of the property is what they're typically going to be looking to do, maybe 95, but they'll go up to 97% if it's like an FHA type loan. That said, what are the pros and cons of hard money? Well, it's really important that you realize there are some differences here, right? Primarily, hard money loans are going to be used for investors, not for homeowners. So let's jump over here. Let's talk about a few things that are going on here when we talk about hard money loans. So over here, let's talk about hard money. And over here, we are going to talk about traditional. With traditional, this is back to what we're talking about, like FHA, VA, those types of loans. Okay, so one of the things, you're going to have some pros here, and you're going to have some cons, right? And you're going to have some pros and cons with traditional as well. So let's talk about some pros to hard money. Now, first off, they're very fast to get. Typically, you're like 10 to 20 days in order to get a loan. And that would kind of be a con. Right now, they're taking about 45 days in order to get a loan. This could be anywhere. Sometimes they can go as much as 15, but typically you're about 30 days to make a closing happen. So you've got speed here, right? One of the pros to hard money is they'll lend in properties that are in poor condition. So what that basically means is that we're able to lend, a hard money lender is able to lend on properties where it needs fix-ups. It may not have a kitchen. It may need a new driveway poured. The HVAC may not working, which is one of the cons you're dealing with here is it has to be in move-in ready condition is basically what that, I forgot a there, but move-in ready condition is basically what this property is going to have to be in. So that's maybe a con. Okay, another pro. So it's fast to get, poor condition. They can lend on properties that are in poor condition. And then the other thing that you're looking at is credit is not a problem as long as you're not in the middle of a bankruptcy, right? You don't want to be in the middle of a BK. So that'd be an exception or have some collections. But if your credit score is not that great, it doesn't really matter where there is credit standards. So you can see here, basically everything that's a pro here is a con here. You're going to see the inverse, which is why these are great things to really realize about. So your credit, you don't have to have job history. And here a con, maybe you have job history is a requirement. And over here, you can do hard money loans with no monthly payments. And over here, the con would be you have monthly payments. Okay, that's just to name a few, and there's a few more, but let's talk about some of the cons of hard money. Cons of hard money is it's more expensive. You're going to pay more, both in an interest rate and on an origination fee. Now, why is that? Why are you going to end up having to pay more? Well, the reason is traditional hard money gets government backing, right? They can borrow at the prime rate, which is sometimes even as close to 0 or 1%, 0.5%. They can borrow with that. But the thing is, one of the reasons with hard money, they don't have a source to go. So it's typically always private funds or institutional funds, but they're not getting subsidized. And like with an FHA loan, if things go bad, they can get some insurance to pay them if there is losses. In a hard money loan, that's not the case. So they have to price that into it because the government's not backing that or helping to support that or pseudo government to help out with that. So it's going to be more expensive. The other reason is they're taking on more risk. A hard money lender, if they're lending on the after repaid value or the ARV, they're lending as to what the property is going to become, not what it currently is, which increases risk. The other thing is they're lending without the credit scores and the job history and the monthly payments and all those things, which increases potential risk on the property, which if those things happen, it would be less risk. So a pro over here is it's less expensive. Okay. Less expensive is what you're dealing with there. So those are some of the things. And so when it comes to traditional, in the other cons for hard money lending versus traditional, it's really just a price thing. Now we're going to get into time frame. Typically, these loans are for 6 months. Well, I should say 5 to 8 months. Okay, it just kind of depends. 5 to 8 months. These loans are for 30 years. Another pro over here is you can get multiple loans. And like with an FHA, you can only get like one for a primary residence, and then you're going to pay a higher interest rate potentially. So the time frame is going to be there, and this is going to be a longer term loan is basically what you're looking at. So here's some different pros and cons as we are talking about the differences between hard money and traditional. So then the real question just is like, when should I use hard money and when should I use traditional? Well, here's basically what I recommend with all of this is you want to use hard money loans for acquisition, for acquiring a property. So if you are wanting to do a fix and flip, you're going to want to use hard money. If you're wanting to do a BRRRR type deal, which if you're not familiar, that's buy and then rent or renovate, then rent, and then refinance. With a BRRRR deal, you're using both. Okay, with a BRRRR deal, you're getting hard money. Once the property's fixed up, you're refinancing into traditional, so you're using both of these. So that's where these go hand in hand. And if you're wanting to do a wholesale deal, if you're not able to get an assignment fee or you need to close, you're going to want to use hard money because traditional is not going to let you do that. And one of the other cons with traditional is they don't want to see you buying and selling properties all the time. If you're getting a bunch of these loans and you're not keeping them for very long, they're going to see that on your credit report and that you're just getting rid of these properties quickly. And they're going to have some problems with that because, and when a bank only charges 5% interest or 3.5% interest, it takes them a while to make their money back. And the average person stays in their property about 13 years. And so these banks are planning on you having the property at least for 13 years so they can recover some interest on that. If you have it for less than that, they're losing money on the deal. So we're going to be looking out for that. So these are just some of the differences between hard money versus traditional financing. If you've enjoyed this, please hit that thumbs up button and consider subscribing to the channel. If you are interested or have a question you'd like to have me answer, just like this one, and I appreciate the question, type it in the comments below and I'll put a video together like this just for you and all my other amazing YouTube subscribers. If you'd like to get a copy of my property value analysis, which will help you analyze properties that could work for fix and flips, BRRRRs, or for wholesale type deals, just text me your email address. Text your over to 435-294-0433. Also, I have a video that goes more in depth on all the requirements that hard money lenders have. I'll link that on the screen so you can check that one out. I also have a blog post on the 6 steps to flipping a house using hard money loans. I'll put that in the comments so you can read up on that as well. Otherwise, please make it a very profitable day and bye for now.